Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. My name is Goose, and joining me on today's show is Mike Mortlock from MCG Quantity Surveyors. And boy, did we cover some ground today. We talked about all kinds of stuff, everything from land tax changes in New South Wales to the future of real estate to changing trends for property investors, and of course, how to use depreciation to scale your property portfolio and get to where you want to go rather than getting stuck. So if you're interested in maximizing your investment, or in fact, just listening to the funniest man in real estate tax, then this is probably the episode for you. So without any further ado, let's get stuck right into it. And I can't wait to see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me on today's show is Mike Mortlock from MCG Quantity Surveyors, the best quantity surveyors in the entire world. Mike, how are you?
Thank you very much. I'm sure there's some great ones in, maybe Afghanistan or something.
Not as good as MCG. I went out and did a survey. I checked.
Did you?
Yeah.
Good man. Well, that's a pleasure.
How are you?
It's great to be back. I'm smashing. How about yourself? What's happened in the last 100 episodes?
In the last 152 episodes, a lot has happened, Mike. So, for those of you who have just tuned into the podcast recently, Mike was actually on episode number 7, all the way back in 2019. Where we talked about unlocking the hidden riches in real estate and making tax fun, which is a great episode. I thought it was really well received at the time. We're now up to episode 159. So 152 episodes later, you're finally back. I can't believe it's been so long. But mate, it's been a wild ride. I mean, what's all the things? COVID's happened since then?
Yeah.
Like all of COVID. It started, It came and went since last time you're on the show.
We were blissfully ignorant about what the next 150 odd episodes had in store for us. And congratulations on those too. I've been tuning into quite a few of those, but yeah, it's been absolutely crazy. And one thing that I like to kind of remind people of is that there was a period of time where we actually kind of didn't know what was going to happen. We thought this could be zombie apocalypse. We might have to get a pump action shotgun. The property market is going to crash, according to all the banks. There was a lot of uncertainty there, and look at us on the other side. I mean, yes, COVID has been a dreadful thing for a lot of people, and people died from it, right? But when it comes to property, it's been an unprecedented time. It's been amazing for investors that have been in the market.
Yeah, 100%, and it was definitely when it all kind of kicked off. It was uncertain for everyone. It was very crazy event. But yeah, for the people who could kind of cut through the noise and get stuck into it, it's been an epic ride. And I personally think, depending on obviously where you're investing, I actually think that right now we're moving into another really interesting phase. And I actually haven't specifically looked at the very specific data around this, but anecdotally, you can see that it seems as though after major share market crashes, there tends to be a boost in the property market as well. Like, so if you go back to like 87, there was a massive share market crash then. And then in 88, 89, there was like 35% property market growth and all of these kind of things. And so I think there's still some really interesting stuff to play out through all of this stuff that's happened, everything from COVID to inflation to Ukraine, now rising interest rates and all this kind of stuff. I actually think that there's still a lot of good opportunity out there, as long as you're buying in the right places, of course.
Yeah, I couldn't agree with you more. And I think when there's sort of volatility, it's a bit like, the stock market goes down, we look to those precious metals. They tend to do better in times of crisis. There's a tangibility to it that correlates with property, right? You can walk up to it and you can touch it, and it's a less sort of liquid thing, right?
Well, it doesn't go to zero. This is the point, right? So like a business can go to zero, right?
Absolutely.
So it doesn't matter how big the business is. The business can go to zero like overnight, pretty much, right? Look at someone like Enron, right? They're bang, gone, right? And so, but real estate won't go to zero, which is why, just like precious metals, it tends to be a really good safe haven. It just like in the last time we had a major economic incident that universally affected national median and median sales price growth was the GFC. So we actually have had property market decline since then, and actually more significant ones. But the last time there was a major economic event that caused that kind of action in there. Do you know 63% of suburbs around the country still went up in value?
Yeah, wow. That's incredible, isn't it?
It's crazy, isn't it? Right.
Yeah.
So, yeah, but it is really interesting because that idea of having that tangible asset that doesn't go to zero is one of the things that I think underpins particularly real estate in Australia. So let's talk about that. Let's start talking about property, tax, depreciation.
Yeah. Did we really make it fun on episode 7?
I think so. I think if we went back to it, if we went back to it, we'd find it fun.
Yeah, good. Okay. Well, I think like off air, your brief was, let's talk about what tax depreciation is and let's try and make that interesting. And honestly, that's been a challenge for my whole professional career, right? Because why should you care? And when I get up on stage and people haven't seen me present before, they're like, "Oh,
how often do you get up on stage? Where are people going? Where are you doing tours and stuff, Mike?"
I'm very big at the Super Bowl halftime show. Stage is I've probably hammed it up a little bit much. When I stand on the carpet in front of, like, say 11 people and 4 of them are my family that I've begged to come, people are guilty of kind of thinking, like, look at this middle-aged white dude with a cheap haircut. Like, this is going to be awful. Like, he's going to drone on. He's going to talk about, well, it was really interesting when the Income Tax Assessment Act came out in 1997. But so I have to really kind of try and shock people. But so tax depreciation is important because it's going to put money back in your pocket. And the worst thing that you can do as a property investor is purchase a property and then be forced to sell it because you don't understand the cash flow or you're having to chip into your pocket and you just didn't really kind of understand it. That could set you back for 10 years, right? And that might actually burn you from getting your second property because, the stats have been updated. It's now 68% of people only buy one investment property. It was 72. So we're getting a little bit more successful, but that's still, in my view, quite unsuccessful because I think people that are investing in property want to fundamentally change their financial future. And there's a fairly strong argument to say that one property isn't going to do it. And tax, I think, fits into that.
Yeah, I 100% agree. So, and there's no exact stats on this either, but anecdotally, I'd say it's about 5 properties is kind of where most people need to get to in order to be able to create that vision that they really wanted, right? That degree. Don't get me wrong, buy 1 or 2 investment properties, and you're going to end up wealthier, assuming you bought the right property, right place, right time. You're going to end up better off, but you just might not get to that goal that you wanted. And this is, I think, where a lot of people go really wrong is they don't assess the risk properly. And one of the biggest risks is continuity risk, right? The risk that you won't be able to continue to grow your portfolio. And that, of course, also to your point comes if you make mistakes and you get set back and you get burnt and then actually you just might never buy again. Or maybe you buy one and it doesn't do what you want and you get stuck and you can't move forward. And so the way that I think about depreciation is kind of like, I always see it as a bonus, right? So I always think about buying assets that are going to work regardless of whether there's depreciation or not. But I can speak for a lot of our clients. I think the average, even though we're buying, because a lot of people think depreciation is only on new properties too, right? So, and all of our clients are buying established properties in established neighborhoods. And I think on average, they get about $3,000 back in depreciation. So whack $3,000 on top of your annual, on top of your cash flow for the year and all of that kind of stuff. And you're in a pretty good place. And it's going to keep you moving forward.
Yeah. I mean, the average across all of the properties that we look at, we chart every day, and it changes every day depending on the types of properties that we do. And it is normally in that sort of $8,000 to $10,000 mark. And of course, those stats get blown out because we're seeing, up to 49% of people buying brand new properties in our data. That's come back into sort of the mid 30s. So with established, it's going to be a little bit lower, but even at $3,000 worth of tax deductions, that could be $1,000 back in your pocket. And we're talking for that for year one, right? So that's just the first year of deductions. And the longer you hold it, the more you get the benefit of that. So that's a pretty significant amount.
Yeah, 100%. So let's start. Just in case people don't know what we're talking about. What is depreciation and how does it work in 90 seconds or less?
What do we got? I've even got like this little. Are we on video or I suppose it's a podcast, so this could be clunky. It's a video. You'll be on YouTube. People tuning in. I've got this little this little timer here so we could press the button on that. So tax depreciation is an allowance for the wear and tear of owning an investment property. So an investment property is kind of like a business. The tenant pays you rent and you've got outgoings, and the wear and tear on the property is considered like an outgoing, right? So as tenants use the property, they're decreasing the value of it because they're wearing things out, they're using it. And as an investor, you're providing a service too. You're putting a roof over a tenant's head. So what it enables us to do is we estimate the construction cost, we calculate those declines in value on all of the different components. At the end of the day, that gives you a report showing what is the value of the decline of those assets each year, and that is a tax deduction. How do we go there? Oh, I got to do my little.
I don't know how you went by time, but I thought it was a really good explanation. And the way that I like to think about it is because it seems a little bit esoteric to people. Hang on a second. I bought a house and tenants are paying me. The value is going up, and I get to claim for the fact that the tenants are using that. That's what they're paying for, right? It is a very interesting concept, right? Because if I have a business and the business is writing, let's just say it's writing letters for people, and I buy a pencil, right? I have to have the capital outlay for the pencil, right? But then as the pencil wears down, right, that asset that I've bought is actually depreciating, right? It's actually becoming less.
Declining in value.
It's declining in value, right? And so what the government basically does is to incentivize you to be able to continue to provide the services to people. It allows you to claim back the loss of value in the assets that you own, right?
Yeah. And if you think about it this way, the government housing stock is around about 3% of the private rental stock. So the government's really kind of out of the public housing business in real terms. And there's a huge waiting list for it as well. And there's a tremendous amount of people that will always rent for whatever reason. I think it's around about 20% of households are rentals. And we can see what happens when investors are de-incentivized to be in the marketplace. And I believe they have been over the last little while. And look at rents at the moment. Like rents have been stagnant for the best part of 10 years. And we've seen huge rental price growth. We've seen, 16-year lows in terms of vacancy rates. It's actually a very terrible place for renters at the moment. And most investors that I speak to, of course, it's great that your rents are going up, but they actually are worried about it. They do care about the plight of renters.
Yeah, it's not good. It's not good. The market dynamics are what they are. Rents are going up because there is a huge amount of demand for rentals. So, you don't. That's just the market conditions. But I don't know anyone who would say, "Oh yeah, it's great that there aren't enough places for people to live." Like it's full on. Like
it's terrible.
It's pretty. And even obviously I'm in Bondi at the moment, and during the kind of like recent, there was the recent boom in Sydney just before now the recent like price decline in Sydney and all of that kind of stuff. But when it was hot there last year in 2021. A lot of investors who had held properties through a pretty rough period, 2017 to 2019, where values went down, prices came back up, and they thought, great, we're going to sell our investment properties. They sold their investment properties. They were bought by homeowners, which decreased decreased the amount of rental stock in the market. And then all of a sudden, there's not enough rental properties for people to live in. It's crazy.
That was a big part of it. And I think the last not the last election, but the previous two really did kind of demonize property investors with the negative gearing sort of rhetoric. We had the Royal Commission, and now we've got a lot of state-based legislation that kind of makes it quite arduous to own an investment property when it comes to the maintenance requirements, and some of those are positive, absolutely. Like people deserve to have a nice, well-maintained property that's safe and all that sort of stuff. But certain things like having to give cause for terminating agreements and those sorts of things, there's been a lot of changes that I think have disincentivized investors.
Yeah, 100%. So depreciation, is it something that only property investors can claim, or can homeowners claim depreciation on their house as well?
It needs to be an income producing property, or at least partially. So my first property I bought as a first home owner, and after a period of time rented out a bedroom. So I did a depreciation schedule on that bedroom, as it were. It's not for purely owner occupiers. It has to be income producing properties, either residential, but of course it can be commercial and industrial or agricultural as well.
Yeah, awesome. And you've done a fair bit of study research, been collecting a lot of data on the property market, property investors, depreciation, insurance, like loads. I know you've been doing loads of stuff in that kind of space. I'd be interested to know, have you worked out like how many people don't claim depreciation? Like, because I think a lot of people don't even think about it. You know what I mean?
Yeah. Yeah, look, the data on that is difficult. I mean, what we can see from the ATO tax stats, which are always like 3 years behind, right?
Yeah.
We can see who's claiming plant and equipment and who's claiming capital allowances. And certain companies have tried to say, oh, well, X amount of people aren't claiming deductions, so they're missing out. But they forget that people that might have owned the property for 10 or 20 years and there is no residual depreciation left and they've claimed it in the past. So we can't actually do that 100% accurately, but there are other things that we can look at. For example, we looked at 1,000 residential property transactions and the time from when they settled on the property to when they contacted us, right? And we found that 6.7% of people waited more than 2 financial years, which is the amount of time that you can back claim on missed deductions. So those 6.7% of people missed out on average $20,537. Now, at the time when we looked at that, which I think was 2 years ago, if you extrapolated that across the property investor population in Australia, it's $2.88 billion worth of missed deductions floating out in the ether that the government is probably going to blow on submarines that aren't fit to spec or something like that, you know.
But that's pretty unreal. Why do you think that is? Why do you think people are missing it? Is it just a lack of information, lack of understanding? You know, is it a lack of knowing who to go to, right? Because maybe do people think it's something that their accountant does? What's your speculation? Why are so many people missing out on this?
Yeah, look, it's a good question. If you think about those stats as well, that 6.7% doesn't sound like a lot, but we can only measure the people that eventually figured it out and came to us, right? So in real terms, it could be a lot higher than that. I think education is a big thing, and you know, I've been trying to educate people for 15 years, right? But you'd be surprised how few people subscribe to my YouTube channel. But yeah, look, there's a lot of I think buyers agents are making a big difference in this space because they're getting it. They're understanding that it's an important part of the property investment journey. It used to be up to accountants, and there's also a few issues even with accountants that don't potentially understand some of the legislation changes. So there was a big change to legislation in 2017, and a lot of people will say, oh, you know, depreciation's not worthwhile anymore. Certainly it's changed, but that I would encourage people to slap anybody. Well, no, after the Will Smith thing, we're not slapping.
No slapping.
No slapping. No slapping. Metaphorically slap anybody that tells you that depreciation isn't a thing anymore. And I think probably the biggest one, and this led me to create sort of 3 triggers telling you when you need a depreciation schedule. And the third one, which is the least obvious, is properties that are built before the cutoff date for depreciation on the original building structure, which is 1987. People don't consider that it might be built in the 50s and you kind of think, oh, there's not going to be any depreciation, but it might have been extended, had a new kitchen, a new bathroom. It could have been completely gutted. So when you go to your accountant, if they're not on the ball, you might say, oh, I bought an investment property, and they say, you know, when was it built? Say, oh, it was 1950. And they go, oh, well, there's not going to be any depreciation. Yeah, You've got to understand the history of the property. So I think that's part of the problem as well.
Yeah, totally. Because pretty much anytime you upgrade the shuttles or do any capital works, right, you can pretty much start claiming on that kind of stuff. So if you put new carpet in, for example, new carpet, new air conditioners, kitchen fit out, new paint. Yeah, any of that kind of stuff you can start to claim, right?
Yeah, pretty much anything that you do to a property. Repairs and maintenance are a different thing, but if we're talking about putting new assets in, they're all going to be depreciable. The only real exceptions are things like turf and plants, you know, anything that could feasibly blow away in a strong wind. Or is it organic material? You can't, but you know, retaining walls and paving and concrete, all those sorts of hard components will attract depreciation.
So do you need to work with people's accountants, or is it 2 separate things? Because you mentioned a lot of people would normally go to their accountant and it was kind of like in the realm of accountants. Sorry, another question. Are more people getting depreciation schedules now than used to be? Do you think the percentage is increasing?
I believe so. What we have charted is the amount of time that people wait to get a depreciation schedule done has halved since 2019. So that speaks to a higher level of education. So I think that's definitely the case. And to answer your question about the accountant, it kind of depends. I mean, sometimes we will chat to the accountant to say, look, this is an older property and the deductions we're looking at are around this kind of figure. We want you to have a chat to the client about their specific tax situation, because we don't ask their taxable income and those sorts of things. Is it worthwhile to get a report done? Because we don't want to charge unless there's any kind of benefit. And sometimes there's some weird nuances in reports where we say, we've treated it this way. We've been given this list of improvements, and about 8,000 of them, or $8,000 worth, we would assume are repairs and maintenance expenses. So it seems lazy, but we don't put them in our report because the accountant can claim them at 100%. So you get an immediate deduction. So that's where there's often a back and forth between us. Now, the Tax Practitioners Board requires that quantity surveyors be registered tax agents, because in some ways, parts of what we do is considered tax advice when we're putting depreciation rates on things. But the big difference between accountants is accountants know the whole tax ecosystem. We just work in a really narrow band of it. And what we do that accountants can't do is estimate construction values. So anytime there's ambiguity about what you've bought, then you need a quantity surveyor to come in.
Yeah. So how does that? So that's really interesting as it relates to insurance, right? Because when you're insuring your investment property, you want to insure it for the replacement value. But then what is that, right?
Yeah.
So how do you kind of play into that?
Yeah. So pre-pandemic, which is a completely different construction environment than we're in now, the Insurance Council of Australia was saying that 83% of homeowners would be underinsured. Now, that's a huge problem, right? And with construction costs having risen so dramatically in the last little while, that number is likely to be much, much higher. And Mother Nature doesn't tend to get less angry as years go on. She seems to be getting more and more annoyed. So it's a huge problem, and something that we've really kind of taken on board as a passion project. So we weren't doing a lot of insurance replacement cost estimates, but now it's probably about 10% of our business. So what's important to understand is that you might think, oh, okay, I've got a nice 3-bedroom house, and then I've seen an ad for this place. You can buy this Clarendon home for $280,000. You're like, oh, that's way better than mine. So I'll just insure mine for that. Or my purchase price is X and my land value is Y. So I'm going to do purchase price minus land value, and that should kind of make it work. But what you've got to understand is when something happens to your house, it doesn't leave a nice laser level debris-free block. You're going to have to factor in demolition costs. You're going to have to factor in cost escalations. You need preliminaries and consultants and designers and architects. And what your property, so your property such as it was, might not actually comply to current legislation. It might not have enough compliance with, say, BASIC's legislation, or it could be built too close to the boundary. And of course, construction costs go up over time. So there's a lot of little bits and pieces that people don't understand. And I've got to say, the insurance calculators that you can get from the insurances, we've done some analysis on those, and they're just wildly inaccurate.
Yeah, it's pretty interesting that you pointed out there as well, because it's an easy mistake for people to make. Like, for example, when you get the rates notice, it sort of say the unimproved land value and the value of the property on top. But then that's actually like as it is. So if you've got a 40-year-old property that's had the windows kicked in and it's half burnt down and whatever, right?
Yeah.
That specific thing is probably not worth a hell of a lot. But if you had to replace it with a new building, probably going to be pretty expensive.
Fortune,
and so ensuring what it is, not what it should be, is a real big gap and a real big thing for people to think about. Because I know, I'll actually confess, recently we bought a property. Gabby and I bought a property, and we got a quote for the insurance, and I can't remember, the replacement value was way more than we paid for the property. And we were looking at it, and we're going, this little joint, no way. There's no way that's worth that much money. But then I guess in the context of it, if we knocked it down and built something new, then maybe that would be correct.
And building it today as well too.
Yeah.
And, like getting back to my original point about the pandemic and us really not knowing what was going to happen, we had a lot of builders try and secure work at very, very low margins, right? Because they were uncertain for their future. Then they're locked into these fixed price contracts, and materials have just went through the roof, and labor became a problem as well. That's where we've seen, a lot of big builders go into liquidation or into big trouble. For the ones that are working on cost plus, that's kind of easier, right? But most people don't sign cost plus contracts. So construction costs have just been going up and up, and certainly we're seeing a lot of the timber mills and things come back online. But we've got global supply shocks. I mean, if you do a Google Earth image, you can just see a sea of ships off the coast of China. Like, the whole world has kind of changed because of the pandemic and because of that cheeky little fella Putin, who's up to no good there as well.
Yeah, totally. But, there is a lot of, what are your thoughts on inflation? Do you think it's going to stick around? Because obviously the reason we've got so much inflation is largely because of, supply chain disruption. The spot price on shipper containers is down 25%. Spot price on microprocessors is down about 30%.
Yeah.
Spot price on fertilizers is down about 27%. So do you think maybe we're passing peak core inflation, or do you think it's sticking around for a while?
That's a really good question, and there's plenty of far more educated people than me.
I just wildly speculate. That's all the economists do anyway. They just are out there having a punt anyway, so you can do it too. It's all good.
Yeah, look, I think a lot of these inflation measures are global sort of temporary supply shocks, but we've also got a domestic component of that as well. I mean, there's been a huge amount of demand. And back when we weren't sure what was going to happen, the household savings ratio went through the roof. So we've actually been spending a lot of money in Australia domestically doing, renovations, and recently in domestic tourism and those sorts of things. And we've got a huge labor shortage, really. I'm pretty sure that this is the lowest unemployment we've ever seen, and a lot of business owner friends of mine, they're trying to get people, and it's impossible, and it's forcing people to kind of have to raise prices, and just the demand is still there, right? So the prices are going up, people are still paying. And I mean, look at petrol. Like, what are you going to do? Not drive? Like, maybe some people will walk or ride or catch the bus, but if you've got to drive to and from work, you've just kind of got to wear it. So I think we've got a little bit longer to go. I think we're going to see a few more interest rate rises, but I don't think it's going to last forever. I think, probably another 6 or 12 months, we could potentially be looking at interest rate cuts.
Yeah, you've been around the block a couple of times. So you've seen the property market go through rate rises before, I'm sure.
Yeah,
you have. What's your take on it? Is it good, bad, or is it just a thing that happens? Or what's your view of the landscape? Do you think it's going to have a negative or a positive impact on property?
That's a good question. And what springs to mind there is that computer models are great, but only when people behave rationally. And I think people behave quite irrationally when interest rates start going up. You can see consumer sentiment tends to disappear. And for the people that, weren't buying into the doom and gloom around the pandemic and invested in property, we can see how well they've done, right? So if you can counteract that kind of herd mentality, what did Mark Twain say? He said, to create man was novel, and to create the sheep was a tautology, right? There's a real thing in that. So I think that the pace of growth will continue to slow. I think we may end up in negative territory for a small amount of time. I certainly don't think it's going to fall off a cliff. This year is obviously still going to probably end in positive territory, but I just think there's some great opportunities in this next little while for investors, certainly.
Yeah, interesting. Another great quote by Mark Twain that I love: that when you find yourself standing on the side of the majority, it's time to pause and reflect. Which is we're very apt in times like this. Yeah, for sure. I 100% agree with you, and I think it's really interesting. When you reflect back to those. When you reflect back to those moments, those big moments of uncertainty, because that's typically what it is, right? It's a moment of uncertainty where people act emotionally, which is fine. Emotions are real. To your point, it's all well and good to be rationally X, but humans are emotional creatures. Let's just own that, right? And collectively, we're really emotional creatures, right? So, but if you look back to any of those kind of major emotional moments in our history, transverse just a couple of years into the future, and then that's usually become a really interesting moment for the people who were able to kind of think a little bit differently and see the opportunities in those kind of situations. Yeah, I know in some of the research you looked into where the distance between where people live and where they invest.
Yes.
Tell me about that.
Yeah, I mean that was an original bit of data that we looked at in 2019 because I was quite interested in it. Right, there's the old adage that people buy around the corner from where they live, and part of the motivation for me starting a podcast 4 or so years ago was that stat that 72% of people only buy one property. I wanted to try and move the needle on that, and I think it's advice, right? And a lot of people buy around the corner because they want to be able to touch it or look at it, or they're like, oh, I know the area. And then you ask them, well, do you know the main employers and the historical growth rates and employment projections? And they're like, no, I just know where the best coffee is and where the most graffiti sort of is. And you go, oh, okay, well, maybe you need to think about that. So in 2019, we found that 29.5% of people invest more than 200 Ks from where they live. So let's call that 30. And more than 200 Ks, that's probably reasonable that they might be buying it sight unseen. And the main headline figure was that the average distance people buy from where they live is 293.47 kilometres away. Now, we looked at that data in 2021, and the average distance actually went to 559 kilometres, which with 44.7% of people buying more than 200 Ks from where they live. So certainly the appetite to buy further across Australia has changed. And this data really probably was finalised when we were still kind of at the back end of the lockdowns. And I really wanted to see what influence the pandemic has had. And I expect that trend to change because there's just so much data available now. And I mean, take yourself, for example, the quality of data that you guys put out that talks about the property market around Australia, not just looking at, say Bondi where you are. You literally can buy anywhere in Australia if you've got a buyer's agent. And I think people are starting to realise that you've got to treat this like a business.
Yeah, 100%. And what's really interesting about that is that the thing that has enabled that is technology, right? Because I actually was talking to someone the other day, actually on the podcast, and they were saying back 20 years ago or whatever, when they had very first started investing, the idea of like owning a property you didn't have emails, or maybe you did 20 years ago, but like once you didn't have emails, you had to talk over the phone. Like, how are you going to get it? Like, there wasn't as much. There wasn't, you couldn't get as much information easily transferred. People were still using faxes and stuff like that. You know what I mean? You know what I mean? So like not that long ago, the technology context which enables people to do that was radically different. Yeah. Whereas now it is, and I say this to people all the time, like once upon a time, the belief was that you couldn't buy a property unless you went there, because what if you walked out into the backyard and just over the back fence was one of those massive power pylons? What if, so you had, the only way you could know that was to go there. And it's like, well, now we've got satellite imagery. So, you can kind of work that out. Right. Which is, so I think, I actually think that that's a really good trend and something that's going to continue. And I actually think that that's kind of really pointing towards a different future for property investing, because I think people are starting to slowly detach from the emotional. Because recently Gabby and I were in Geelong visiting Gabby's parents. We've got a property in Geelong, and we were driving through Geelong, and I was like, oh, should we go and have a look at the house? And we were like, what for? And then we were like, what are we going to do? We just look at it. It's a house. And we just kept driving. We didn't even bother. We were just like, no. And I think that as people get less emotional about their investments, that actually changes the context about how they can invest, and actually helps them to become more sophisticated. And I think that that's actually probably playing a role in the fact that the number of people who own one property is actually down to 6 to 8%. And that's hopefully allowing people to become more successful.
Yeah, I agree. And good on you for that. I think the fact that you turned away stopped you from being, say, a chubby personal trainer, which nobody trusts, right?
Yeah.
You're sort of living by what you're saying. And I had a similar thing recently where a property that we purchased not far from where we were on holidays recently, we purchased that sight unseen. Later on, I did actually go and inspect it. And I said to the wife, we're sort of going past, you want to have a look at it? She's like, not really. Like, we're on holidays. Let's go and do holidays. I'm going to look at a house.
Look at a house that you can't even go in. It's okay. It's kind of fun going in houses and having a look around. But what are you going to do? Just drive past and staring in the windows like a.
Look at that. And then the tenant maybe looks at you and you're looking at the house and like, oh, this is just awkward.
Weird, isn't it? Yeah. People, you think you can get arrested for that, peeking through the curtains.
I think so. Well, yeah.
So I think another really interesting thing that is potentially going to change the future of property investing as well is changes to the stamp duty and land tax that they're trialing out in New South Wales. I would love to get your take on what you think about the recent changes or the proposed changes to stamp duty, land tax, all that kind of stuff.
Yeah, my first thought is good on any government coming up with a policy that kind of could be politically damaging for them. It's bold, right? And politics in Australia has been so much more about that cycle and being re-elected. And that kind of mindset doesn't give us projects like Snowy Hydro, right? Like I'd love a politician to say, we're committing to this. When will it be finished? I don't know, 50 years. I'll be dead potentially. But this is what Australia needs.
Let's go. Let's change something.
Yeah,
let's make a dent.
Let's do something. So I think it's fantastic that they even began the discussion on it. And obviously the first home buyers is a real sort of test case for whether they're going to do that for everybody. They've been very clear on that. And I think New South Wales will be a test case for the whole of Australia. And I can see it going to that. I mean, I sort of compare it to sort of like the subscription underpants or the shaver shop of stamp duty sort of analogy, right? Because it's ongoing revenue. Stamp duty revenue in New South Wales is around about a quarter of the revenue. And there's a lot of people saying, well, this will be hard for the government because it will decrease the revenue. The crossover point is somewhere around about 20 years of ownership, and people aren't necessarily doing that. But what I think it does is it removes part of the biggest hurdle for first home buyers, and that's coming up with the deposit. I think what it also does is it increases mobility, and that's a real problem in Australia because we do have little old ladies in 4-bedroom houses that want to leave, right? They want to downsize, but there's, it's kind of like there's this loss aversion when you buy a house. I've thrown all of this stamp duty and it's not really fit for purpose, but we've only been there 3 years and that money goes in the toilet if we leave now. So I think it's really positive, and I think it's a good thing for first home buyers. And I think, they deserve to be commended on having such a bold policy. What about yourself, Goose? I'm interested.
I think it's awesome. I think it's awesome for a couple of reasons. So from a business model perspective for the government, I think it's actually really interesting because if you imagine somebody buys a house in 1970, they pay stamp duty on it in 1970, they might have paid whatever, $2,000 in stamp duty. And then let's say they still own the house now. The government has only ever collected that stamp duty once and at a really low value, a low price then. Right?
Yeah, with the time value of money, right?
Exactly, the time value of money. So reducing the upfront charge and moving it to a land tax, which is obviously going to re-rate on an annual basis, right? As the land value changes.
Yes.
I actually think that's really, really smart because long term, it's going to be a better revenue model for the government. It's going to be more consistent,
I think,
and it's going to grow and it's going to have a massive compounding effect. I actually think, from a business model perspective, I think it's really, really smart. It's going to be damaging a little bit to the cash flow and all of that kind of stuff. Short term, long term, great move. I think it's going to be better for everyone, and I think it's going to be better for everyone, not just the government, because it does reduce that kind of upfront barrier to entry, right? And that's a big thing, right? So, I think, from a first home buyer perspective, I think it's awesome. From elderly mobility rate perspective, I think it's awesome. Property turnover rate, I think it's awesome because one of the biggest problems with real estate is the entry and exit costs, right? Yes. So on average, it's about 10% entry and exit costs, right? Basically, right? Yep. So if you can reduce that down by reducing the upfront stamp duty, then that actually makes it easier to buy and sell and trade property. So you can actually turn over your properties faster, right? Which actually allows people even if it's their home, not just investment, to move more frequently, feel less stuck, all of that kind of stuff. So I think it's got a huge amount of benefits. And then the futurist in me, I believe that once we can break down a few more of these barriers, so stamp duty being one of them, and then once we can move to smart contracts, smart digital contracts, and exchange instantaneously, we're actually going to be able to start moving to a more of a high frequency trading kind of model in the real estate. I think that's the future of real estate personally. Yeah. So I'm really excited. I think this is a step towards a great destination. And look, not that the property market needs any more reasons to grow, because we currently have a housing shortage, right? Yeah, so it'd be great if housing would actually catch up with the demand for a little while. I think that'd be good from a social perspective, but also increasing access to property and decreasing the barriers to entry is obviously going to increase the participation rate in real estate as well, which is going to drive up values also.
Yeah, and think about the economic benefits of that transaction volume, right? So if we're seeing more property transactions, there's a lot of people that get fed in the property space. I mean, around the carbon tax style thing, the mining companies were talking about, how big are employers we are. But when it comes to property, they're like a pimple on a backside, right? Property is huge. So when a property transacts, you've got, your pest and building people, you might have land surveyors, you've got, you might have sort of title insurance, you got your solicitors and conveyancers, your real estate agents, your property managers, your buyer's agents, whoever it might be. There's a lot of people that kind of do get fed when a property changes hands. So that could be a huge economic impact as well.
Yeah, exactly. I think it's smart that's why I think it's going to benefit. It's really beneficial to a lot of people. And I actually don't see a lot of downside with it, aside from the fact that, in the sort of near term, it'll create some kind of cash deficits in the state budgets and stuff like that. But generally speaking, I think it's a great move.
Yeah.
Nice. Well, mate, before we wrap it up, I'd love to kind of dig in, because we kind of started talking about depreciation, right? Then we went off on a tangent, but I'm really interested in just kind of closing the loop on the depreciation piece as well, because I think that this is one of the, as we called the first episode we did, unlocking the hidden riches in real estate. I really think that this little unknown and hardly ever used piece in the real estate is really the key to maximizing your return on investment. Right. So, what do people need to know about it, or how would they know if they should be thinking about it, and then how would they know if it was right for them, or any of that kind of stuff?
Yeah, look, I think you touched on a really important point before, that tax depreciation is a bonus. It shouldn't be a strategy, but wherever you have that bonus, you need to take advantage of it, right? So I came up with 3 triggers telling you when you need to get a depreciation schedule. One is you buy a brand new property. That's probably the most obvious. We don't need to talk too much about that. 2 is if it's built after the cutoff date for depreciation on the original building structure, which means it's automatically worthwhile. Now, you can remember the 16th of September 1987, or you can just remember, say, post-87. But a quantity surveyor will also give you free advice as well. So don't be afraid to ping an email with the address of the property and say, is there anything in it? Because if you do that to me and there isn't anything in it, I'll tell you and say, like, we can't in good faith recommend you proceed with this, because you won't get your money back. The other one is if it doesn't match point 1 or 2, if it's built prior to 1987, you need to look at the renovations and the history of the property. And I've been in properties with owners before saying, oh, look, this is extended. And they're like, what do you mean, really? I'm like, yeah, come and have a look under the house. There's a set of back steps going to the center of the property. That's a fair indication that something's different, right? Because they just left the steps when they did the extension, because why not? Because they're just going to be hidden, right?
Yeah.
So a lot of people don't even know the history of the property. So those are the 3 triggers. And what it really does, like when you think about owning a property, probably the biggest deduction is going to be your interest component that you're paying with the bank. You do have your property management, repairs and maintenance fees, but tax depreciation is quite likely the second biggest deduction that you've got. And any amount of cash flow that helps you hold on to that property and helps from a serviceability point of view and helps you get to that second, third, and hopefully 4+, which puts you in the top 4% of property investors, that's where we want to be, right? So tax depreciation has a role in that.
Yeah, I think it's an awesome tool, because, to your point, the thing that allows people to get to that level, to that 4-5 properties, to join the top 1% of property investors, is understanding all of the tools you have at your disposal, like learning how to play the game of finance, learning how to maximize your returns, learning what structures are going to be most appropriate to get to where you want, all of that kind of stuff.
Yeah.
And that's good. You can't just bimble along and kind of hope you get there. You need to actually understand, what tools can I use? When should I use them? How should I use them? And who should I speak to? And how do I build the right team around me? So
you need a team. I love the word bimble too. Don't bimble.
Yeah. Don't bimble. No one should. You're not going to bimble your way to success. You won't do it.
No way.
So Mike, speaking of team, if somebody wants you to be on their team, how would they get in touch with you or your team?
Yeah.
In order to explore this opportunity?
Yeah, I'm pretty easy to find on LinkedIn and Facebook. It's Mike Mortlock, and the company is MCG Quantity Surveyors. So if you think about the Melbourne Cricket Ground and then you put QS on the back for Quantity Surveyors, then you go .com.au and you'll hopefully find us.
Easy. Mike, thanks so much. It's been great to have you on again. We've got to make sure we don't wait another 152 episodes to get you back on here.
I think so, yeah. We need another swim in Bondi at Arctic temperatures as well.
Yeah, sounds good. Okay, mate. Great to see you. Great to speak to you. We covered a lot of ground today. I really enjoyed the conversation. So thanks again.
Yeah, always a pleasure. Cheers, Goose. Thanks a lot.
Speak soon.